You've been told the housing market is fine. You've heard the experts say it's stabilizing, that prices are leveling off, that things are getting back to normal. Sure, normal. Except there are $347 billion worth of unsold homes rotting on the market right now, the highest number ever recorded. Normal. Except 1.1 million American homeowners are underwater on their mortgages, more than any time since 2018. Normal. Except the largest home builder in America just reported a 30% drop in profit and is sitting on 20,000 unsold homes. That doesn't sound like normal to me. That sounds like a slow-motion train wreck. Today we're laying out 10 facts about the 2026 housing market that nobody in real estate wants you to hear. We're talking tariffs jacking up construction costs, foreclosures climbing for 12 straight months, entire states losing population. And that number one fact? It's the one that proves the American dream of homeownership is officially on life support. Let's hit the road. Number 10. Tariffs are quietly making every new home more expensive. Here's something the real estate agents won't mention during your next open house tour. The cost of building a brand new home in America just went up, and it's not because lumber got rare or labor got pricier. It's because of tariffs. As of April 2026, according to a Cushman and Wakefield analysis, current tariff rates have increased construction material costs by roughly 6%. The Associated General Contractors of America reported in their April 2026 update that tariffs of up to 50% on steel, aluminum, and copper are driving 8 to 10% cost increases for builders. Softwood lumber is carrying a 10% duty. Kitchen cabinets, a 25% levy, set to climb to 50%. The National Association of Homebuilders estimated these tariffs effectively raise the cost of building a new home by about 3.3%, which translates to roughly $10,900 per house. Now, $10,900 might not sound like the end of the world, but here's where it gets ugly. That cost doesn't disappear. It gets passed to you, the buyer, on top of already record-high prices. The American Progress Institute projected that these tariffs could result in 450,000 fewer new homes being built through 2030. Fewer homes means less supply. Less supply means higher prices. Higher prices means more people locked out. And here's the absurd part. We're in a housing affordability crisis. Everyone agrees on that. And the policy response is to make building homes more expensive. It's like trying to put out a fire by throwing gasoline on it. We're just getting started. Number 9 gets worse. Number 9. Foreclosures have been rising for 12 straight months. Remember when they said the post-pandemic housing market was bulletproof? That homeowners had too much equity to ever get in trouble. Well, somebody forgot to tell the 38,840 families who received a foreclosure filing in February 2026 alone. According to Adam Data's February 2026 foreclosure market report, foreclosure activity has now increased year over year for 12 consecutive months. That's a full year of climbing. Foreclosure starts, the beginning of the process where you lose your home, rose 14% from a year ago. Completed foreclosures, where the bank actually takes your house back, up 35% from last year. Lenders repossessed 4,077 properties in February alone. January was even uglier. Foreclosure starts shot up 26% year over year, and completed foreclosures jumped nearly 59% from the year before. Housing Wire reported that January filings reached 40,534, a 32% annual increase. And the geographic spread tells a brutal story. Indiana leads the nation with one foreclosure filing for every 1,597 housing units. South Carolina is at 1 in 2,217. Florida, the so-called paradise, sits at 1 in 2,277. The worst metro in America? Lakeland, Florida, at 1 filing for every 1,075 homes. Think about that. In Lakeland, roughly 1 out of every 1,000 homes is in some stage of foreclosure every single month. Adam CEO Rob Barber called it a gradual upward trend. 12 months straight doesn't feel gradual to the families packing their boxes. Speaking of places that feel the squeeze, let's head to the Sun Belt for number 8. Number 8. $347 billion in homes are just sitting there. You want to know why the housing market feels weird? Because it is weird. We're in a market where prices are technically still up, but nobody's buying. Sellers are listing, buyers are scrolling past, and in the middle is a mountain of unsold homes bigger than anything we've ever seen. Redfin's March 2026 analysis found that more than half, 52.2%, of all U.S. home listings in February had been sitting on the market for at least 60 days without an offer. The total value of that stale inventory? A record-breaking $347 billion. That's up 4.3% from a year ago, and the highest level ever recorded for this time of year. The typical home that went under contract in February spent 66 days on the market, the slowest pace Redfin has measured in a decade for that month. And here's the kicker. There are 630,000 more sellers than buyers currently active in the market. That's a record gap. Sellers outnumber buyers by more than 2 to 1 in cities like Miami, San Antonio, and West Palm Beach. Miami leads the nation with 62.6% of its inventory classified as stale. So, why aren't sellers dropping their prices? Because they're stubborn. Redfin agent Jason Gale in New Orleans put it perfectly. Sellers know it's a buyer's market, but they still want to get as much money as they can. So they list high, expecting buyers to negotiate down, and that's leading to listings staying on the market for a long time. It's a standoff. Sellers won't budge, buyers can't afford it, and $347 billion in homes just sits there collecting dust. Number 7 explains why an entire state is losing its people. Number 7. California is losing population, and that's not supposed to happen. California, the Golden State, the place where everyone in America supposedly wants to live, the land of Hollywood, Silicon Valley, and $4 million starter homes. Well, people aren't coming anymore. They're leaving. The U.S. Census Bureau released its latest population estimates in January 2026, and the numbers confirmed what many suspected. California's population declined by 9,465 residents between July 2024 and July 2025, landing at 39,355,309. That makes California one of only 5 states in the entire country that lost population last year. Of the top 20 most populous states, California was the slowest growing, or, more accurately, the fastest shrinking. And it's worse in the cities. Los Angeles County alone saw its population drop by approximately 60,000 to 70,000 residents between 2024 and 2025, according to Fox LA's analysis of census data. That's the largest population decline of any county in the entire United States. What's driving the exodus? You can start with housing costs. The median home price in California hovers around $800,000, more than double the national median. Add in sky-high insurance premiums, state taxes, and the general cost of living, and the math simply doesn't work for middle-class families anymore. Then came the wildfires, the insurance cancellations, the rebuilding costs. Here's the irony. California's population loss is actually accelerating the housing crisis for the people who stay. When tax revenue drops, services decline. When neighborhoods thin out, commercial areas die. When your neighbor leaves, your property value doesn't go up. The state that was supposed to be the promised land is turning into one you flee from. Number 6 hits even closer to home. Literally. Number 6. 1.1 million homeowners are underwater, the most since 2018. Here's a number that should terrify anyone who bought a home in the last 3 years. As of the end of 2025, more than 1.1 million American homeowners owed more on their mortgage than their home was actually worth. According to ICE Mortgage Technology and Atom Data, that's the highest number of underwater borrowers since early 2018, a 7-year high. The share of underwater mortgages rose to 2.1% of all outstanding mortgages, up from just 1.3% a year earlier. That's a 60% jump in the percentage of homeowners who are in negative equity in a single year. MarketWatch reported that the damage is especially concentrated among government-backed loans. 9.6% of VA-backed loans and 5.7% of FHA-backed loans were underwater coming into 2026. Let that sink in. Nearly 1 in 10 veterans with a VA loan owes more than their home is worth. The geographic concentration is equally brutal. Louisiana leads the nation with 10.7% of mortgaged homes seriously underwater, and some Florida metro areas are approaching 1 in 10 homeowners in negative equity. These are the people who bought at the peak between 2021 and 2023, locked in high rates, and watched their neighborhood values flatten or decline, while their loan balances barely budged. Adams' Q4 2025 Home Equity Report showed that equity-rich homeowners, people who owe less than half their home's value, dropped to 44.6% of all mortgaged properties, a 4-year low. The equity boom that made everyone feel rich after the pandemic? It's quietly evaporating. If you're feeling uneasy, wait for number 5. It's about what happens when insurance becomes a myth. Number 5. Over 1 million Florida homes are completely uninsured. Picture this: you own a home in Florida. Hurricane season is coming, and you have zero insurance. Not bad insurance, not expensive insurance, no insurance, nothing. You're going bare, as the industry calls it. According to a February 2026 report from K&C Group Real Estate, over 1 million Florida homes are completely uninsured, approximately 1 in every 5 residential properties in the state. The Consumer Federation of America found that more than 12% of homeowners nationally have elected to go without insurance entirely. In Florida, where premiums have more than doubled the national average to $5,000 to $6,000 a year for a typical home, that number is significantly higher. And it's not just the uninsured. A 2025 study cited by the Invading Sea found that 78% of Floridians are underinsured. They have coverage, but it won't come close to replacing their home if something happens. People are cutting coverage just to save $3 to $5 a day. Insurance companies keep leaving the state. The ones that stay keep raising premiums. Premiums rose 30 to 40% since 2022 alone. Governor DeSantis announced some rate relief in January 2026, and Citizens Insurance proposed its first rate drop in a decade. But even with reductions, Florida insurance costs are still among the highest in the country. Here's the part that's truly insane. If your uninsured neighbor's house gets destroyed in a hurricane and they can't rebuild, their abandoned property tanks your property value too. One uninsured wreck on your block drags down the whole neighborhood. Going bare isn't just a personal risk, it's a neighborhood-wide financial contagion. Number 4 is about a desert running out of more than just patience. Number 4. Arizona is building houses where there's no water. You'd think, is there enough water, would be question number 1 before you build 60,000 new homes in the desert. Apparently not. In 2023, Arizona's Department of Water Resources made a bombshell announcement. The Phoenix metro area didn't have enough groundwater to support all the development that had been approved. Construction on thousands of homes was effectively halted. It was the first time the state admitted its most valuable resource, water, was running out. The response? Arizona didn't fix the water problem. They changed the rules. In late 2025, the state passed a new ag-to-urban law, allowing developers to build in groundwater-restricted areas if they agreed to retire nearby farmland and transfer those water rights. By February 2026, according to AZ Central, new home builders were already flocking to use the loophole. About 60,000 new homes were approved under varying water compliance frameworks. Meanwhile, the Colorado River, the lifeblood of the entire Southwest, faces deeper cuts heading into 2026. Arizona's allocation keeps shrinking. Wells in rural areas on the state's western edge are running dry. And the Arizona Department of Water Resources is now scrambling to regulate groundwater in areas that were previously unregulated. High Country News reported on the dried-out subdivisions of Phoenix, where a groundwater crisis literally halted construction mid-build. Streets paved, lots graded, model homes standing, no water to fill them. Here's the thing nobody in the Phoenix real estate office will tell you. You can negotiate price, you can negotiate closing costs, you can even negotiate a free pool. You can't negotiate water. When the aquifer is gone, it's gone. And you're holding a mortgage on a house in the desert with no tap water. Number 3 is about the biggest home builder in America hitting the panic button. Number 3. America's biggest home builder just reported a 30% profit drop. D.R. Horton, America's builder. That's literally their slogan. The largest home builder by volume in the entire United States. And in January 2026, they reported that their first quarter fiscal 2026 net income fell 30%, dropping from $844.9 million to $594.8 million. According to their investor report filed January 20, 2026, homebuilding revenue decreased 9% to $6.5 billion. Homes closed fell 7% to 17,818 units. Homebuilding pre-tax income plummeted 30% to $708 million. And here's the number that should keep every new construction buyer awake at night. D.R. Horton ended the quarter with 30,400 homes in inventory. 20,000 of those were unsold. 7,300 of those unsold homes were completed, just sitting there, finished, empty, waiting for a buyer who isn't coming. And D.R. Horton isn't alone. Fortune reported that during Q4 2025, nearly 20% of all new construction homes had a price cut, according to Realtor.com data, more than the 18% rate for existing homes. That's the first time in recent memory that new homes are getting slashed faster than resale homes. According to NAR data, about 40% of builders cut prices in December, with average reductions around 5%. Nearly two-thirds, 67%, offered incentives like mortgage rate buydowns, the highest share in more than 5 years. Builders are paying an estimated $52,000 per house in concessions just to move inventory, free rate buydowns, closing cost credits, design upgrades. Some builders were reportedly offering free Teslas and vacations just to close deals. When the biggest builder in America is bleeding money and giving away cars to sell houses, that's not a healthy market. That's a fire sale wearing a suit. Number 2 will make you question whether the next generation will ever own a home. Number 2, the age of the first-time home buyer just hit 40, a record. Think back to when you bought your first home. Were you in your mid-20s? Maybe early 30s? Your parents might have been even younger. Well, those days are dead. According to the National Association of Realtors' 2025 profile of home buyers and sellers, the median age of a first-time home buyer in America has hit an all-time high of 40 years old. 40. That's not a young couple starting a family. That's middle-aged. Meanwhile, the median age for repeat buyers, people buying their second or third home, has climbed to 62. The overall median age of all homeowners nationally is now 57.5 years, according to Realtor.com's March 2026 analysis. But the age isn't even the most disturbing part. The share of first-time buyers in the market has cratered to just 24%, down from 44% in 1981. Think about that. In Reagan's first year in office, nearly half of all home buyers were buying their first home. Now it's less than 1 in 4. The NAHB's February 2026 analysis confirmed this. First-time buyers have been systematically priced out of the market for over 4 decades. And who's filling the gap? Investors. The New York Times reported in February 2026 that investors accounted for 30.2% of all home purchases in 2025, up from 16.1% in 2020. So while families are being pushed to 40 years old before they can buy, investment firms are snapping up properties at a rate nearly double what it was 5 years ago. The American dream used to be work hard, save up, buy a house in your 20s, raise a family. The 2026 version: work hard, save up, watch investors outbid you, rent until you're 40, and maybe, buy something you can barely afford. Number 1 is the fact that ties all of this together, and it's the one that should scare you the most. Number 1, 52% of American households cannot afford a $300 home. This is the number that explains everything. Every statistic we've covered, every trend, every crisis. It all comes down to this. According to the National Association of Homebuilders' February 2026 Housing Affordability Pyramid, 52% of U.S. households, roughly 70 million families, cannot afford a home priced at $300,000. Cannot. Not would struggle. Not would need to stretch. Cannot. The math doesn't work. The income isn't there. The savings aren't there. The credit isn't there. And here's the gut punch. The median price of a new home in 2026 is approximately $410,000, according to the same NAHB data. That means the median new home in America costs $110,000 more than what the majority of Americans can afford. In 39 states and the District of Columbia, more than 65% of households are unable to afford the median-priced new home in their state. According to an Axios analysis from January 2026, over 75% of homes currently on the market are unaffordable to the typical American household. The National Mortgage Professional reported in February 2026 that a prospective buyer needs an annual household income of roughly $111,252 to afford the median-priced home. And even with recent improvements, the typical household still faces a $25,000 income shortfall. Harvard's Joint Center for Housing Studies found that the national median single-family home price grew to 5 times the median household income in 2024, approaching historic highs last seen just before the 2008 crash. 5 times income. Your grandparents bought a house at 2.5 times income. Your parents, maybe 3 times. Now it's 5. And while all of this is happening, the homeownership rate sits at 65.7%, near a 25-year average. But that number is being propped up almost entirely by older homeowners who bought decades ago. For younger generations, homeownership isn't declining, it's disappearing. The market isn't broken for the people who already own homes. It's broken for everyone else. And that everyone else is now the majority of the country. Conclusion: 10 facts, 10 warnings, and 1 undeniable reality. The 2026 housing market isn't recovering, it's revealing. We showed you tariffs adding tens of thousands to construction costs, while the country can't build enough homes. Foreclosures rising for a full year straight. $347 billion in homes sitting unsold. California losing people. Over 1 million homeowners underwater. 1 million Florida homes with no insurance. Arizona building subdivisions in a desert with no water. America's biggest builder hemorrhaging profit. First-time buyers waiting until 40. And over half the country unable to afford a $300,000 home, in a market where the median is $410,000. This isn't a correction. This isn't a cycle. This is a generation being told the door to home ownership is closed, while the people who already own are watching their equity erode and their insurance get canceled. Before you sign that contract, before you write that check, before you tell your kids, just save a little more, ask yourself, is the system working for anyone anymore? Or are we all just pretending it's fine while the foundation cracks underneath us? Don't be the last one to see it.